Hey everybody, welcome back. Well, we have a lot to go over, a short time to do it, so let's jump in. Let's talk about the S&P 500, the ES. What did it really do today? Nothing. The only thing that we can talk about here before we start jumping into some of these stocks that crushed earnings after hours, only thing we could really focus on is just that they're dojis. And we know that dojis are signs of uncertainty for one, but the wicks are to the downside, which means we have net buying, meaning in this bar, what did we have? We had some buyers and some sellers battling it out and they won. Well, the wicks basically tell you that we no longer have sellers here or here and that we're setting up. Now, there's a rumor floating around, and we're going to talk about the rumor later in this video about non-farm payrolls on Friday, but we have more data that's going to come out before then. But we're going to want to watch the top of this. We're going to want to watch that. Where are we at? 53, 25, 75. We're definitely going to want to pay attention to that. We certainly got to look at what's going on with the pricing power out there because people are not understanding why IWM is going down, and I'm going to explain why IWM is going down. We covered it a little bit on Saturday, but before we do that, let's talk about the NQ and what's going on there. So let's dive into that. Now, first and foremost, I always appreciate your comments, so keep them coming. It's helped me greatly get the better mic and actually even helping with the video. So keep the comments coming. It does help me. But wicks, again, just pricing to the downside. So when we look at this, obviously it's a little bit of a concern, but not a lot, right? And I don't really think there's much to say or do about it. And what we're seeing is I'm seeing a lot of people getting frustrated. I think what your trading has to tell you is that if your trading's frustrating you, you're not waiting for the right opportunity. So let me show you what I mean by this. If we just kind of do the simplest of things and just pick June, for example, and just take this data point that has pretty solidified where June was at 8:30 on Friday, and then we just take that data point as well. What are you noticing here? Well, from here over, we haven't gone anywhere really in the NASDAQ. A matter of fact, from Friday to here, this move was 2.5%, 2.3%. What was this move if we took the low from here to there? What was that move? 1.26%. See a pattern? How about this one? And we could take that to the high, 1.2, 1.3%. Okay, so we're getting tighter and tighter here, right? Why is that important? We're waiting for economic data. We're really waiting for data to come out and tell us what's going to happen. But before we get into that data, let's go over something. Now, before we go any further, I just want to do a quick review. On the call, we were live doing the pre-market lives that we do every morning, and we talked about corporate profits and how they were so off. I want to go over this because there's a concept that a lot of people are not getting here, and I want to understand why. I want you guys to understand why it's happening before we go. Because you're watching IWM drop and people are not getting why. It's corporate profits, and I'll explain it. But it's important to get that concept before we get into it. And then we should also talk about what's going on here before we go any further so that you see how this is all playing out. So economic data, and when economic data is coming out tomorrow, this is important, and then I'm going to link to today's data. But you have the S&P Composite PMI final. Now this is before the ISM comes out. This will come out at 9:45, and then you'll see right here the 10 o'clock will come out. When this comes out, it's going to move the market. Okay, this number needs to be decent, but not too decent. It's kind of a rock and a hard place right now for us guys with this economic data. They did a real number on us here. Fed's got us boxed in here real nice, for lack of a better term. So we have to see this data. We have to see what's going on. We do not want a number this hot. We do not want to see a composite anywhere near this. Anything over 55 is like just automatic auto that you're raising rates, which is crazy considering the other data that I'm about to show you. So we really have to watch how this plays out. I mean, it's really hot. And then you have services PMI coming in later. The one data point that you have to watch for Friday is going to be this ADP employment change, and that's at 173. Now remember, ADP is different than BLS, which is the Bureau of Labor Statistics. There's a difference, and people always equate these. Just remember, ADP does ADP data. So ADP data is private companies that have an average of 30 employees or less. Really important to get that. And that's going to follow through based upon what we had with today. Now with today's data, if we just take a look at where we're at and some of the stuff we saw, the JOLTS job openings, well, we're losing jobs, right? So we have 8 million jobs down from the 8.3 million that we had before. And that is somewhat important for us to note, but just understand that that did come in well and the market did respond favorably to it. Now, we're going to get into the heat map. Let's do that in a moment. Click off of this and clean this off. But I want you to get this before we start diving into the IWM, because what people are noticing is a disparity. And I want to talk about this because we're also seeing a disparity in what's going on in the oil markets. And I'll explain that one as well, because I think that could be pretty profitable. But if we look at the IWM, everyone's saying the same thing. Well, when this is down, that means yield must be going up, right? So if we overlay this, and then we just go here and we put in the 10-year, and you're going to see that we're starting to see a disparity. And the disparity that you're starting to see, in other words, as yield is dropping, the market's going lower. That's not what's happened in the past. Here you are, and you can see this in November. And what happened in November with IWM, which is the blue line, we would go higher, and then you would see the bond market, yield would drop. So we'd rally and yield would drop. What's the difference now? The difference now is that earnings are not what they seem to be. Now we have two really good earnings calls tonight, and I don't think people really got it, but we'll dive into it. But what's important about this is you are seeing a change in trend. So what was happening before is not working. And then you have to go and say, okay, well, why? So if we go out here and take a look at Chicago PMI, and I'm going to do everything through TradingView because it's just easier for me right now. And let's clean all the drawings off. And for lack of a better term, we can just leave up the TXN for a moment. And if you look at that, you're going to see a little bit of a follow through, aren't you, on that? And you can actually see that as PMI goes, what happens with the bond market. But I don't want to spend an inordinate amount of time on that in comparison because I really want to focus on the most important part of this, the numbers that came out. Now, we did do this on Saturday, but for those that haven't seen this yet, I think this is very important for you to get. This is 1972, 1968. For our purposes, what we're going to review is I'm going to stop at 82 for a minute. I'm going to say this to you in two different ways. Number one, the reason that the market is dropping is because PMI, Chicago PMI, is falling off a cliff. And this is a precursor to a recession, right? More than anything else. And that's what's scaring people because the recession here starts with corporate profits. It doesn't start the same way that people are talking about the other kinds of recessions based upon, oh, they're going to cut rates, therefore recession. No, recession based upon the E not being in the PE. And now if you have Chicago PMI indicating this, what you would do is go, well, what's happening here? Okay, well, that's May. We know what happened here because that's November, right? 2022. We know what happened there. And then we know how the market responded to that, what happened here. Okay, and this is when, remember when GDP went negative right after Powell decided that maybe he did too much stimulus? Shocker, right? And then this is the great financial crisis, and this is the tech bubble. And then back here is when Volcker stepped into 17, 18% interest rates. It is not common for this to happen. There are two takeaways from this. And there's a book I mentioned in the pre-market live. The book's called The Hedge Fund Edge. And if you want to understand how to trade this stuff, you want to get that book. It's by John Boucher. It's worth reading. Now, if you look here, you're not buying the breakdown. You're buying the breakthrough, the return. So you can go yourself and go look at the market in 1982 in July and say, was it a good time to buy the market? Was this a good time to buy the market? Was this a good time to buy the market? You can literally go and take a look, and they were excellent times once they turn to go and buy the market. Once they turn, you need the turn. We don't have the turn yet. We're still dropping. So for our purposes, this is why corporate profits are being driven down and IWM is going down. And instead of them buying IWM, let's go back to this for a moment. What are they buying? They are buying treasuries, and therefore they are also buying TLT. And this is what's happening. The chances of them cutting rates is getting astronomically faster and faster. Now, this one took a little while tonight because I was trading and I had some other stuff to go over, but I wanted to put this together a little bit more like a Saturday video because some of this, you need to connect some of these dots before you continue trading on the week. I think you do. I am. But here's current. Okay, so for those that don't know, this is CME Fed tool. Anyone can go there. This is free. Here's your current target rate, 525, buck and a, right? 5.25, 550, 5.5. What's the chances of them raising? Well, that was 1%. Well, that's slim and none, slim left town. My dad used to say that. So there you go. So anyway, 82% chance we're going to stay where we're at. 17.5. Well, that's not too high, right? Well, that was a little goofy. All right. So what we need to do is then go, okay, what happens here? 10%, 15%. So we went from 10% to 15% to 17.5. So in 1 week, you're at a huge increase. And if tomorrow's number is decent, it's going to go even faster. Bloomberg is starting Bloomberg TV, which has better actual financial news, which I will turn on in the morning. They're already moving the July rate cut. They're moving. The chances of that rate cut are moving. And I understand why. Now, if we look at that and we see how this is going and we see what's going on with the bond market, there's a chance that this data tomorrow can really move the market. And so that's what we have to pay attention to. But what sectors are going to benefit the most from this? Now, the rumor is this. The rumor right now is that this non-farm payrolls is going to be a disaster, meaning to the downside. And there's a couple of reasons for that I'm hearing more than anything else. So give me 1 second here. I recently switched everything back to a Windows computer. I'm just getting used to it. So this is actually by Anna Wong. Now, This is from Bloomberg, and Bloomberg Economics issued this report. And what I think is interesting about this is non-farm payrolls is Friday. Now, I've heard two reasons why non-farm payrolls could be going the way of the dodo, meaning it could be dropping precipitously. And the reason that I've heard that's being floated is because the way that they are counting people that have recently crossed the border, and supposedly that is inflating the number, and that is going to be discounted on Friday. This is another way that I'm hearing about it right now. So they're talking about this revision. Now, non-farm payrolls, this has been floating out there on trading desks for a couple days now, but this is Anna Wong, an economist at Bloomberg, and she puts pen to paper. Asked after the May 1st FOMC meeting what factors would lead to rate cuts earlier than planned, Chairman Powell cited unexpected deterioration in the labor market. Very interesting language that she picked up on, really smart. So an unexpected deterioration in the labor market, even though he saw little chance of that, but we think such a surprise is in store. Several Fed officials seem to believe labor market is still tight, but we estimate based on more comprehensive measures that monthly non-farm, that's NFP, that comes out at 8:30 on Friday. ADP is the precursor that we just went over, but ADP's data is tied to ADP. Stay with me. Job growth by 730 last year, with hiring maybe even falling below zero. Overstated job growth by 730, 110. And what I heard was that it's about 100 a month that they were adding by, quote, accident into the number. I just did air quotes for those that want to know. I'm not going to put my tinfoil hat on. Let's just get to it. Much of the downward revision was due to a surge in business closures, even as new business formation slowed sharply in the second half of the year. Factors the payroll prints don't take into account. That's convenient. When we see the same factors at work this year adjusted for these distortions, we estimate the true pace of job growth is below 100K per month, substantially below the 242 three-month average in the printed. By the end of the year, the printed level of non-farms will likely overstate true employment by at least 1 million people. Crazy, right? With more than half of the BLS model for estimating business formations and closure. Now, for whatever the reason that it is or it isn't, these are the rumors that are floating around the desks. If that is the case, then what we're going to see is a rally in the market. Now, what is one of the reasons why this could happen? I've been talking about pricing pressure for some time after I saw that corporate profit numbers, and we've been watching corporations completely just, software companies in particular, just not do very well. Now, I showed this yesterday, and I got a couple comments on it, so I just want to reiterate what we're looking at here so that you get it. So this is Manheim, and now this is what you refer to as the canary in the coal mine. Used Vehicle Value Index. This tells you exactly what the average price of a vehicle is. And you can see from 98 to how we've been moving along, and then we hit the great financial crisis, and you buy everything super cheap, and then we just start grinding, right? You have some movement here. And then, it's just, FOMO for everybody, 1.7 trillion, JPEGs are called NFTs, and they're worth millions of dollars, and then everybody owns wallpaper 2 years later, right? The car business stayed up in average significantly, fell apart, rallied, it's collapsing. Now, I went over this yesterday, and I just want to hammer this point home. If you own a car, and your payment, and I'll show you why this is so important. If you own a car, let's say like there was a Rivian that somebody bought, and that Rivian was a $100,000 car. A year later, 14,000 miles on it, that Rivian is going for $58,000 at auction. If you own a car and all of a sudden your payment's $800-900 a month, and that car has negative equity, you're not paying that car. People are going to start walking away from their vehicle, and they're going to default. And that creates a whole other litany of issues. But that's what happens. They're not going to roll the payment into something else that's falling apart. If you don't have pricing pressure and things are not holding their value, they just get out of the way. And it's also the high-end market that's doing this. And by high-end, I mean, like if you go and price out like ultra-luxury vehicles in general, they're imploding. They're way more imploding than they usually do. And the reason is the pricing power. That's a really important distinction because that's corporate profits. Those corporate profits lead into the E and PE, and that's one of the reasons that when you look at TLT, you start seeing it trade up higher. And then what people are doing, stay with me, it's going to be all connected, bringing it home right now. They're connecting that and saying we need to get in the IWM. But the IWM is going to have lower corporate profits. Remember, the IWM, if people default on their bills, IWM is 15.9% KRE, right? Regional banks and financials. So how are they going to do if people start defaulting on their debt? Because you know what? I don't need this Toyota Tacoma or whatever they bought. I'm not going to pay that. That's crazy. That's fine. I default. Just take the car back. This will get it repossessed and I'll go buy a beater. And that's what's going to happen. And then the banks are going to be stuck with stuff that's underwater. And it's not just going to be cars. It will be other stuff that, could be kitchen material, anything. You get where this is going and how this could be a problem. So then the question becomes, well, what areas would benefit the most from this? Now, some people are going to say the home builders. right? So you're going to go look at the home builders and go, well, they must be moving. They're not. Why? Because what's happening is the price of a house based upon where lumber and materials are is not able to hold. Okay, so the house in and of itself and how that's going to be priced for them to make money, they're not going to have pricing power. And that's what's happening. I did this trade the other day and I could not figure out for the life of me why it didn't work. Not that everything I do works, as everybody's aware, but it shouldn't have done this. It fell apart. Now you have this bear flag, the 55, and this thing's getting ready for the, fall apart, which usually home builders do when they're trading at 2 times earnings. But again, so there's no pricing power here, is there, right? That's the problem here, because now they paid too much for the land, or they had the land, but the materials and the cost, but people are going to say, but they're going to cut rates. It's not going to matter, because even if they cut rates, yes, you're going to stimulate some people, but you're not going to stimulate everybody because the cost of the property is still going to be too great and they know that it's going to go up. I'm going to cover this more on Saturday because you can actually see the disparity out there. It's pretty interesting how many homes are being built versus pending home sales. I believe pending home sales or new home sales were negative 7.7%. We covered it a little bit. I want to do more on Saturday. So this is going to be another issue for the economy, that there's no pricing power towards the house, or where this could lead. So who's going to benefit the most from this? And this is where, to me, I think it gets really fascinating, because you start looking at names like, oh, well, copper? Well, copper's got to be flying, right? Because copper's hot. Copper's fallen out of bed. A week ago, I said things changed drastically and people aren't talking about it. You can see where we're at. What's copper doing? Imploding, right? And it's not just copper. And you look at gold, and I'm going to go through 2 sectors that I think you need to watch, but I want you to get the concept before we go through this. So then you look at gold and go, well, gold's coming down. Well, how about crude? Why are they dropping like a stone? Why are they increasing output at OPEC? And why is Biden all of a sudden fine to go buy for the SPR again, right? Because he knows that this is going to come down, or not him, his advisors know that this is going to come down. We're at $72 oil. We have not been back here for some time, and nobody's talking about this. Now, I do want to overlay this because there's 2 things to take from this, and then I'm going to tie it to 2 companies that came out with earnings, and I want to show you 2 sectors that, in my opinion, will benefit greatly from this. But if we overlay this, and what I want to do is I want to just show you something pretty simplistic. If you look at crude, just crude itself, that means what? If crude comes down, we know that CPI and PPI are tied to this. Even though it's housing, we know everything's tied to this. But if we do the simplest of things, and what we'll do for time's sake, because I really want to cover this, and it's really important, again, that you get it. But for time's sake, I'm just going to do it this way. So if I mark here, and we just mark these lows where the RSI drops, you can see it right in here, right? All these times, what happens? Well, we get a little bounce, don't we? I'm wondering if we're getting ready to have some kind of bounce here in crude. And that would be significant because we need the bounce, and I'm going to show you why we need the bounce. Because then if you take that, right, the oversold, and you tie it home with this, and you go to the SPY, and then you turn this into a line, stay with me. Here's crude. Here's the SPY, and here's crude. Well, these trade in tandem. Okay, these have been trading in tandem. You can say it, right? What's happening? We're decoupling. So either the S&P has got to come down or crude's got to rally. Now, based upon where we are on RSI, I think crude's going to rally some. That's what I think. But we need to watch this disparity. We need to pay really close attention to that. Before we get into those 2 names, let's cover 2 sectors, because now you should know, in my opinion, what's going to rally or what has the potential to rally. So if we look at crude oil, do you really want to go out there and start buying the energy sector by looking at that? I'm going to say that I think you want to start looking at it. I think you might be getting washed out. I think there might be some value here now. Now, we're not completely blown out of the water yet, but we're going to want to start watching. We're going to start wanting to watch this stuff. I think we are. That's my opinion. If I do the simplest of things and just overlay a 12, a 22, and a 55, that's what I should use. You should use what you're comfortable with. And I just pop in a 200 before we get into these 2 sectors. I held the 200. So maybe that's it. And then we just start going through the usual suspects and seeing if there's anything there. Oxy, I need to get that a little lower down here at 55, 56. And then you blow it out here in the 70s. That's what we just did last time in the community. That's the way to trade this thing, in my opinion. But let's get to it. Okay, so who benefits with rate cuts, so that you would know who's going to benefit? XBI benefits. XBI benefits because biotech can then borrow money cheaper. If they can borrow money cheaper, they can do more projects. They can do more trials. They can fund the trials better. They can do more business, which then gives them the ability to drive it higher. It also means that they don't have to go out on the secondary market as much. They can just do debt. If they get the prices cheaper, they don't have to do equity. Secondaries are less. less supply, more demand, you get it, right? And a great way to trade this is LABU. This is definitely something that should be on your radar. Next, XLRE. Everyone keeps talking about them and, oh, there's no pricing power there. That's the only place that there is pricing power. What's crazy is, who's getting pricing power? We kept hearing about the end of the world. These guys in New York that own office space are getting pricing power. They just are. It's a fact. I think that they're at like 91 or 92% occupancy. You can say what you want, but that's what's happening. Now, it's not all over the place, but VNO, SLG, watch this SPG. If they start cutting rates and they can refinance all this debt cheaper, the pricing power of these, their earnings will go through the roof, which will increase the dividends. So these all make sense to look at, in my opinion, and you can pick the names, which ones you like, which ones you don't like, based upon the sectors, and which ones are housing, which ones are medical. SPG, biggest malls out there, and the malls are going crazy for whatever reason. We keep hearing about the weak consumer, but the malls are going crazy, and I think that's really important. Now, understanding that and looking at the heat map, what we're going to do with the heat map is take the S&P 500, not market cap, but we're going to look at volume on the day again. And then what we're going to do is get rid of everything except the extremes. I'm going to leave the extremes on, and I want to point something out. We went over this on the volume on the day yesterday, and it showed us CCL. So you shouldn't be surprised. See how this all is connected? We had a great trade in the community today because we bought CCL, and we knew that these were going to be names to watch. CCL, NCLH, RCL, all of them rallied again. And what are we seeing here? FCX implode, NEM implode, NUE implode, steel implode. Why? You know why. We just went through it. So could this follow through down tomorrow after the ADP data? Yes, it could. Hopefully you're getting how this is all connected, right? Once you understand this and you understand the way that the stool actually works, this starts to make more sense, right? We talk about the fundamentals, the macro, and the technical of the stool. I'm not going to bring it out for time's sake. But then you could just kind of drop down here and go, who are your big dogs? Well, that shouldn't be surprising, right? We've been watching them buy these kinds of names. They're the Verizons. They're buying yield. Why would these names be rallying? Well, oil is imploding. It takes a lot of oil, a lot to run those. And you come here and you take a look at this, and what are you seeing? All your commodities are imploding. Why? Less pricing power. Earnings are going to drop. Hopefully you get how this is all connected. Let me know if these are too long on the weekday, but there's just so much going on out there that's worth talking about. Now, we'd be remiss if we don't go over this. So NVIDIA comes out with a new chip and the stock hits an all-time high. If you're betting against the stocks that are hitting all-time highs and hammers at the end of every day, you don't know who's buying at the end of every day. It's institutions. And what you're seeing is you're seeing the push. I personally think we would have gotten way more of a move out of this, but understand what we went over on Saturday, the skew is going to change, right? I'll link Saturday's video at the end. I'm not going to go through the skew again. But what that means is you're going to have huge volatility. Look at the volatility you're getting here. They're breaking you out at new highs, and then they're matumboing you. Retest, and then they rip it, right? Who's doing that? Institutions are doing that. Now, the question is, how does this play out? I think you're crazy if you're betting against a stock that's doing this right now. You're hitting hammers every single day on gap ups. It goes until it doesn't go. You're better off not telling the stock what it's going to do and just trading what's actually happening. Believe me, you'll be happier and you'll be way more successful. But there's some things here that are finally clicking, and I think that they're really important, and we're going to go through them. So first and foremost, crowd. I want to go through this trade. I had a real nice trade on this today at the end of the day, and it was quick. And I want to show you something. I'm going to leave it highlighted. My entry was right here. So crowd broke down. I'm not going to do the timestamps or anything for time's sake, but flips, entry, my exit is that bar right there, all right? What I'm doing is I'm letting it walk up, and once I got to the gap fill, I'm trimming into that area, then I'm trimming in again, and then it pushed again. One of the key things about this call was not only did they beat, and they're one of the first softwares to actually beat if you go look at the disasters out there, but they raised guidance a little bit. So I think that's pretty significant. The reason I highlighted this, in the room, and they traded it and did exceptionally well with it after hours. This is how long it took me to make that move. I think it was like $15 on the last piece was the most. If you're playing the rest of it, the move is here. This is why you need to understand fundamental analysis so that you can read it, make your trade, and get your trade on. The rest of the people are waiting for this to clear and get above the gap fill. And look at the amount of money that they would have made and the risk that they took into the call versus what we made here. It's a really important lesson there to get about understanding why fundamental analysis is so important and how to implement it. There's a big lesson there. I think there is. So that's why we went over it. The other thing I would say is HPE. And I think that this is just fascinating. So we keep hearing that, oh, this business, it's no good, server's no good. We're just not seeing any real pressure there. We're not seeing margins. We're not seeing anything, blah, blah, blah. They come out, crush, raise, up 10%. They're crushing it, knocking the cover off the ball. Okay, this was a sleeper. So you had two great tech companies come out with earnings. It's really hard to look at that and then just say, oh, well, that's not going to go higher. Personally, the only reason I think that didn't go higher today is because we were all baffled and had to become geopolitical experts figuring out why Mexico fell off a cliff and what the heck's going on in India. And frankly, for me to touch base on this, I can only give a little bit of an opinion that it looks to me like it was just unexpected, but according to the polls, this is exactly what they expected. For us, we're just going to play the hand that we're dealt tomorrow, and now you have your game plan. That's it.